So you want to learn about spreads, selling options, and stop losses the safe way. What I'm going to show you right now is the truth behind selling options. Is it really that risky? Is it really too good to be true? Can I put stop losses? How do I protect myself? We're going to get all into it in this video and show you how to make maximum profits. Let's go. So for us to really get into the nitty-gritty, the first thing you need to understand is what actually are spreads. Well, spreads is like becoming an insurance company on options. When you go ahead and sell spreads, what you're actually saying in effect is that you're willing to take on the risk on options and actually get paid for it. Okay, so what does that look like? That looks like, let's say somebody owns 1,000 shares of Microsoft, okay? Your favorite company. They own 1,000 shares of Microsoft. And Microsoft is right now at $522 per share. Well, they want to limit their downside risk in case there's a recession or something happens to the stock market. So they say, I'm only willing to get to 480. At 480, I want somebody to be able to buy my shares at 480, thereby limiting my risk. Well, with the spread, you take on that responsibility. You're willing to sell them insurance to take on the risk that the stock won't get to 480 or below within a certain time frame. And that's the key word there, within a certain time frame, okay? That time frame is called an expiration date in the world of options. So what we usually do as a pro trick is that we limit our expiration dates to maximize our profits. So for example, just like any car insurance, they can sell you car insurance for 3 months, for 6 months, for 9 months, for a year. Well, we do it on a bi-weekly, monthly, even sometimes weekly basis to maximize our cash flow. So what we will do is say, hey, I'm willing to buy your Microsoft if it gets to 480. For that insurance I'm providing you, you're going to pay me a premium up front. Usually that premium is somewhere between 10 to 15% on your money every 7 days. Imagine making 10% on your money every week. You will literally double your money in 2 months on autopilot. This is what we call accelerated growth, or the velocity of money. So what we do then is we say, hey, I'm willing to sell you insurance that if it gets to 480, I'm going to buy it from you. But in case we don't have the cash to do that, to buy 1,000 shares of Microsoft at $480, which would be like 480,000, just doing the math in my head. What we do then is we buy the insurance from somebody else. So we sell it to 480, and for example, we buy at the 470. That, ladies and gentlemen, is what's called a spread. The difference between the 480 and 470 is a spread, and it's actually a $10 spread, okay? This spread is what's also called a vertical or a bull credit spread or a bear credit spread in the options world, depending on what you're doing. But we're just going to call it a spread, okay? This is what we call a put spread, since we're protecting the downside of the contract. Now that you understand that, you understand that your spread is $10. Well, in the world of options, everything is times 100, because every options contract contains 100 shares of each stock. So if you're doing a 10 spread and you sell one options contract, that means that you're doing a $10 risk times 100 shares, which means that you're risking $1,000 in that trade. Now, here's the truth about stop losses and 3 things about spreads you need to understand. Now that you have the general concept. Number 1, the larger the spread, the less profit or percentage you're going to make on your money, okay? But also, the larger the spread, the more you can do stop losses on it, okay? And before I get to number 3, let me break these 2 issues down very plainly. For example, you sell a 480 and then you buy a 470, that's a $10 spread. You can also sell a 480 and buy a 450, making it a $30 spread. The reason people do a $30 spread is that now it allows you to do stop losses. The spread is so wide that it's not going to kick you out of the trade right away. Okay, so the spread is so wide, it's not going to kick you out of the trade right away. If you put a spread on a 500, 200, or $1,000, if you put a stop loss on a 250, 500, or $1,000 spread, your stop loss is going to kick you out very, very early in that trade. Ask me how I know. I know this because it's happened to me a lot of times. And the trades that I would have been profitable on, I ended up losing hundreds, sometimes thousands of dollars because my spread was too tight for a stop loss. This is a lesson I had to learn the hard way. So if you're doing $10 spreads, stop losses pretty much have to be visual, which means you look at it when the market opens and then you exit or get out of your trade manually. But when you have a wider spread, like a $30 spread, there's more room in between. You take on more risk, but then it allows you to put a stop loss. The general rule of thumb for stop losses when doing a $3 or $30 or higher spread is usually the general rule for stop losses when doing the $30 spread is usually 2x to 3x the premium you were paid. So for example, if you were paid $1,000 in premium for this trade, your stop loss will be 2,000. Okay, which means that you were paid 1,000, your stop loss is 2,000, which means that the premium you got paid got eaten up, and then you lost an extra 1,000. So your real P&L loss with that 2x stop loss will really be $1,000. If you put a 3x stop loss, that means that you will be putting a $3,000 stop on it. But what you will really be losing in actual P&L is 2K, because remember, with spreads, you get to keep the premium paid you up front. So that is the key distinction that you need to notice when doing this. Okay? So larger stop losses for larger spreads. When you're doing spreads that are $10 or less, what I have noticed that your stop loss is going to kick you out mad early, even if the trade is going your way. When I asked support about it, they said it's because of the fluctuations in premium. So just be aware, if you're going to do tighter spreads, okay, stop losses are usually meant to be manual, okay? Because if you do it automatic, you most likely will get kicked out. But what I've noticed, the reason people do tighter spreads is that you get paid more money per unit. So for example, for a $10 spread, they might pay you $150 premium per contract. For a $30 spread, they might only pay you $120 premium per contract, per $1,000 you risk. So you're making more per contract the tighter the spread, but with the longer spreads, you're able to do stop losses that kind of protect you because the spread is wider. This is what you have to balance. Me, I usually prefer the tighter spread of risk. I like to get paid more. So what that would look like is, for this you would get paid $150, but for this, because of the $30 spread, it will be $120 times 3. You would get paid $360. Okay, premium. Even though it's more premium in total, it is less per unit. At the $10 spread, you will probably get paid $450 if you did 3 of these contracts versus just 1 of these contracts. You see the difference is really about 25% in cash flow. So you have to decide what's more important to you: the ability to put automatic stop losses that you don't pay attention to, or to maximize your premiums. I usually choose the former, but if I know I can't watch the market for whatever period of time, whether I'm traveling, whatever the case may be, then I might choose to do the latter. So I'm just giving you an idea what you're up against. The third thing about these spreads is that you can also mix and match, okay? So let's say you have, for example, $10,000 to play with. You can do 2 of the $30 spreads and then 4 of the $10 spreads, giving you a total of, guess what? The 10K capital being used if you're planning to use 10K in spreads. I'm always a big believer in mix and matching risk while maximizing potential results. So let's actually look at a sample trade and see what that looks like. So this is the SPY, okay? If I wanted to sell a vertical for, let's say, next week, Friday, okay, I can do a $10 spread. I'm just going to choose these contracts at random. Okay, I have other videos explaining how to pick contracts, but I just want to kind of go over stop losses. So let's say I do this one right here, right, at 605, and I do a $10 spread, which I'm selling a vertical here, 605 and 595. That is a $10 spread. You notice that it's going to pay me only $3 per contract. Now, when we choose contracts, we get paid a lot more than this. This is just a random example with a random ticker, but so you can see the difference. But now look what happens when I do a $30 spread. So that is 75. So if you see the difference, it's only paying me 7 cents for 30 spread. But when I did the 10 spread, it paid me 3 cents or $3 per contract. So if I just bought 3 of the $10 spread, I would have actually made $9 on this. But because I bought 1 of the $30 spread, I only made $7 on this per $1,000 I put up. So the difference between that $7 and $9 premium is literally something between 20 and 30%. When that compounds, it's a lot of cash. This is just a very layman's example, but let's say I wanted to do something for real and I wanted to sell Tesla, for example. And for next week, I'm going to do the 420 vertical just so you can see how it pops up, okay? And look, I'm going to get paid $166 per $1,000, which is 60% of my money. That's great money, okay? But let's see the difference now when I make it a $30 spread. So I'm only going to get paid $334 if I do a $30 spread versus if I do a 3 contracts of the $10 spread, I'm going to get $498. The difference between $350 and $498 is literally 33%. So you can be leaving anywhere from 20 to 40% of your money on the table. So you have to decide yourself, is having an automatic stop loss that important to you? Or do you mind checking on it every day or every other day just to see how your trade is performing? That's going to be the difference, whether you want to maximize cash flow or focus more on automatic trading happening for you. That's really the truth about spreads, stop losses, and selling options that I wish I knew from the beginning, and now you know. Again, the third point I made, you can always mix and match the two. Have some at the $10 spread, have some at the $30 spread. And the $30 spread is just an example. You can go $40, $50, $60 spread. The same example works. The larger the spread, the more risk you're taking on, and the better it is to have a stop loss, but you're going to get paid less premium on your money per percentage basis. So you decide how you want to maximize your profits, and I will see you on the next video. Chat soon.